Good morning, everyone. It's Thursday, the 23rd of January, 2025, and I want to speak with you about the portfolios and the world and investments and what the thinking is about constructing portfolios over the next 6 months, and give you some insights as to what is going on and give you some facts that will assist your thinking that's away from the newspapers. We've been doing this for many years now, and we've defined and refined a process and a system for looking at facts and figures and how to best construct a portfolio and how to make good choices with your investments. And I want to share some of those key things with you, what the numbers look like now, January 25, and what they look like in July 24, for example, 6 months ago. People think, well, do I invest in cash or do I go into a portfolio? Portfolios are not doing well, so I'll go in cash. Cash is not doing very well, I'll go into a portfolio, and they end up chopping and changing and jumping around, which you really need to stop that and just have an emergency reserve in cash per se, and then the rest of your investments in a portfolio. But when people want to take a low risk and they're looking at one and the other, they end up having far too much cash in hard cash, and then they have a low risk portfolio because they're low risk, and they end up with far too much cash in the whole thing and the whole system, and it doesn't really work. So really your strategies needs to be have sufficient cash in emergency funds and have the rest of it invested. We say that because before 2008, you could simply put all your money in a cash deposit in the bank and you would beat inflation. Inflation is our competition, and we've got to beat inflation all the time. So we look at what's the relationship between these investment structures to determine what is the best strategy going forward. And to date, it's still the same, i.e. what you can get return on cash is less than inflation. So let's just take a look at some numbers where we are now, although the gap is closing and it is changing. We've got a Bank of England base rate which is 4.75. That does not mean if you put your cash in the bank you're going to get 4.75. However, we looked at the best rate and you can get 4.75 at the moment with a 1-year fixed rate. Inflation is currently at 2.6. That was November 24. So inflation at 2.6, cash in the bank at 4.7. Well, we're seeing quite a change in the world, and it's the first time since 2008. So what's the strategy going to be? We look at the expected returns on cash. So if you've got cash deposits in a, sort of a variety of things, what's the expected return? And within a portfolio and return, we're looking at 3.6. So if we've got inflation at 2.6, expected returns on cash at 3.6. If we've got cash in a portfolio, you could get that. If you've got cash in the bank, you get 4.75. You don't have all the platform charges, blah, blah, blah. So really, where are we going over the next 6 months? And the landscape is definitely changing. Expected return on fixed interest, which is the next layer of risk in a portfolio, it was 4.6 and it's now at 4.9. So the cash piece in a portfolio is less attractive than fixed interest. So we really want to keep a watch and keep it lower on a cash piece within a portfolio. Fixed interest has risen at 495, which is good, and then the rest of it is equities. And whilst they're more volatile, i.e. up and down movements, they are the most predictable, believe it or not. So there's some of the facts, some of the headline news that we're seeing at the moment. Big thing on bond yields which are, and gilt yields, which is government debt. So we looked at May 2008, and the yield, the 10-year yield on a UK gilt was 103. Now we're at 4.9. Huge change there. Big drop between July 12 and July 13, going from 123 down to 2. It's a massive collapse, and we're more or less the same. There is talk about it going up, and you know, a number of 1 change is significant against a low number. The surge is reflecting a growing market and the concerns there about the government borrowing plans, and the markets are saying we won't lend without a price. So if the government continues borrowing heavily, then investors will demand higher returns, leading to higher borrowing costs for the government. We all know about the talk about Rachel Reeves and the choices that she's making and all the stories about that, and further tax increases. But it's a fine line between further tax increases or spending cuts which would dampen growth and business and consumer confidence. The growing challenges that she has, she's playing a central role in shaping Labour's fiscal policies. We know the bond yields that we've just spoken about is a significant issue, and we wait to see what happens with those, and they're the key things that we're looking at. What else has been a big cost recently? Los Angeles fires, enormous, absolutely enormous. Only a handful of deaths in comparison to the enormity of the devastation and the destruction, but the insurance costs estimated 150 billion, make it one of the costliest wildfires in US history. How that's going to be met is, that's a very, very significant issue. So to summarise, if you are looking for a low-risk portfolio, which many of you are, I don't think any of us want to put our hard-earned wealth to high risk and, from a frying pan into a Los Angeles fire. With a well-constructed portfolio, it won't be that devastating. A low risk, we have between 3, 4 and 5 numbers. Our scale goes to 10, so even at 5, you're halfway along the risk scale. But the balance of your total wealth, look at what you're hoarding, look at what your strategies are, and if you are looking at day-to-day and short-term views, you will have far more cash in the bank than you have in invested portfolios. And that's going to be a problem, because your problem is you're going to be flipping from one to the other, making bad choices about, well, if the market's great this year, or the market's not so good this year. And the trouble is, you'll only find out what the market is doing or not doing after it's happened. So if the market has gone down, we know what human behaviour is. You're not going to invest in a down market, even though you should. You're going to say, the market's down, I'm not putting my good money into that. You'll wait for the market to come up, the market bounces up, and then you say, right, now it's up, I'll invest. And then you end up selling low and buying high. Disaster. So look at your whole balance, trust the markets will win in the longer term, and find the right risk level that you can bob along with the volatility without feeling you need to shift. Thank you for your time, and I wish you all well.